Good afternoon, and thank you so much for joining us for our 2022 Latin America forecast. My name is Abed Delgado. I'm the Digital Marketing Director of America's Market Intelligence, and I'm going to be serving as a moderator for today's webinar. So before we want to start, we want to give you a quick overview of what to expect. The first thing is the presentation itself is going to last between 50 and 60 minutes, and then we'll take your questions. You can ask questions at any point in time during the webinar. The way to do that is if you look at your participant panel, you'll see a series of icons, and one of them is Q&A. If you click on that Q&A icon, it'll bring up a window, and you can type in your question there at any point in time during the webinar, hit enter, and we'll receive it. And we're also going to stay late today for the webinar to accommodate as many questions as possible. So the webinar will end roughly at around 1:30 p.m. Eastern time today, but we'll stay a half hour, if you will, and try to answer as many questions as we possibly can. So that's one of the things we wanted to make you aware of. In addition, people always ask if the presentation material is going to be available after the webinar. And that's a common question. So the answer to that is yes. We'll send those out within 24 to 72 hours after the webinar concludes. All right, so let's move on to the next part of our webinar, which is the legal notice. This one is kind of lengthy. I'm not going to get too into it so we don't take away time from the actual presentation, but it basically discusses sort of liability issues, things like that, and that we expect to use the information today in conjunction with sound business practices and other information. So we will not accept responsibility for commercial loss due to business decisions based on the use or non-use of the information presented here today. All right, now a little bit about us. Some of you may know us, some of you may not. So let's talk a little bit about our particular background. AMI senior consultants have been operating in Latin America for the past 29 years, advising clients on how to invest, advising them on how to grow their businesses, and also how to protect their investments in Latin America. Over the course of that time, we have completed more than 3,500 market research and market intelligence projects. Now, AMI consultants are essentially in the business of helping customers answer questions. A lot of them are very important strategic questions, such as where should they invest next year? Will my new product enjoy success? Which business partner should I seek out? Or should I buy a business in Latin America, or should I build it up? So these kinds of questions can be both strategic and tactical, and they require information and advice to arrive at a good decision. So we provide the intelligence, so we derive our intelligence from three particular sources. First, it would be your customers and potential customers, your competitors, legitimate and in some cases illegitimate, and also our reading of the business context. So that means the political environment, the regulatory environment, and also the economic environment. These three external sources of information, when properly analyzed, can help you make good decisions, and this is what we do for our clients today. Now, today you're going to be hearing from our leadership team about how we see Latin America in the coming year. And this presentation itself is designed to be as broadly appealing as possible. So we're going to cover a wide range of industries and also the macro environment that unites these industries in Latin America and the Caribbean. Now, we also do paid forecasting engagements as well for certain clients, particularly during the strategic planning season, which tends to fall towards the end of the year in September, October, and November. So in these instances, companies bring together their senior leadership, and what they're trying to do is establish plans for the upcoming year, or maybe a strategic plan going out for the next few years. And in that instance, we, AMI, are brought in as external objective forecasters of the region itself and of the specific industries of the company that hire us for this sort of thing. This usually involves pairing a couple of our practice leaders so that they can provide that sort of objective forecast. And the logos that you're seeing up there are from some of the clients who we have helped in this area over the past few years. Now, this brings us to our speaker list. I'm going to give you a quick rundown here in order of appearance, so to speak. When we actually start the presentation, John Price, the managing director of AMI, is going to go over the overview of the sort of the global overview with Latin America, how other conditions in the world are going to affect Latin America, as well as the regional forecast, and get into sort of what we can expect with specific markets and which specific industries will do well and other ones which may struggle over the course of the next coming year. Then we're going to get into some of the larger trends that we expect to see happening and continue in Latin America. One of them involves digital commerce. So for that, Lindsay Lehr, who heads our payments practice, is going to discuss digital commerce and what we can expect to see in 2022. We're also going to be discussing commodities. because that is an area of great interest from our perspective in 2022. So for that, we're going to have Alejandro Álvarez, who heads a lot of our mining projects, make some discussion there. And then we're going to have Arthur Deakin talk about the energy prospects. He co-leads our energy practice. Then to wrap, in addition to that, as part of digital commerce, by the way, just to take a quick step back, we're also going to talk logistics. And so John is going to handle a couple of the issues there in terms of the logistics, as that also is affected by digital commerce. All right, so now that was a bit going backward, and let's go back forward. So to wrap up the presentation today, basically we're going to be doing an outlook for the healthcare system and rebooting it basically after the COVID-19 pandemic. And so for that, we're going to have Guillaume Corpart, who heads our healthcare practice, lead that discussion. All right. So those are the basics. Now, before we get started, we do want to have a quick poll question because we'd like to get your perspective on a certain issue. So I'm going to launch that poll now, and hopefully you can participate. It's basically, we want to get an understanding from you as an audience, how you feel about what 22 looks like for your company. Do you expect it to be much worse than 2021, just slightly worse, perhaps better? So these are a couple of different options there. All right, we're just waiting for that to sort of load and for everyone to be able to participate there as far as that's concerned. Give it a little bit more time. Certainly in talking to our clients, we've seen quite a bit of optimism. And I think that the numbers, as we discuss them later, will be bearing out that there, for a lot of industries, there is definitely reason to be optimistic, though we don't want to prejudice your responses there. All right, I think we have a good number of participants here. So let's close that poll and let's take a look at those results there as far as that's concerned. Okay, so from our perspective, it looks like, most are quite optimistic. I mean, 68% think it's going to be even better than 2021 or much better, and 22% about the same. And then relatively lower percentages, 9% worse than 2021, and only 1% of you think that it's going to be much worse than 2021. So that's kind of interesting to see that there's that optimism going, and hopefully that'll definitely be the case for all of you in terms of the better and much better. All right, now I'm going to turn the floor over to John Price to start leading off our discussion, starting with the global drivers of growth and risk in Latin America. John.
Thanks, Abel, and thank you everyone for attending our forecast today. We've been doing this now for several years, and forecasting in Latin America is never easy, but it's particularly challenging when you're coming out of a economic recession, in this case triggered by a pandemic and the lockdowns, but nonetheless a recession. And when we try to understand and try to forecast Latin America, we can't simply look at what's going on inside Latin America. This region relies too much on foreign capital, technology, and foreign markets to drive its own economy. So we also have to look at the externalities. And thankfully, we're in an environment of very positive external forces economically for Latin America. Let's begin with the fact that central banks around the world over the last 18 months have increased money supply by 22%. Now, all things being equal, this should translate into annual inflation of about 14%. We have not seen inflation levels that high because a lot of this cash sits on the balance sheets of corporations and governments and even wealthy households. So a lot of cash is being held back as a precaution by different types of savers, but it will be spent as people feel more comfortable, as people feel the pandemic is behind them. And that's going to be an enormous driver of cheap capital and therefore growth for a region that's undercapitalized like Latin America. If we look at the next slide, another big driver of every Latin American recovery is always being exports. And Latin America is well positioned, I would say, in many ways to rebound strongly through exports for a number of reasons, starting with the fact that the region's biggest customers are China and the United States, both of whom, for very different reasons, are enjoying robust growth this year and should have reasonably robust growth next year. And on the next slide, we'll see exactly the kind of mix of that these two countries represent. Over the next 4 years, China and the United States together will represent 1/3 of total GDP growth increase. So the fact that Latin America is well positioned as a supplier to both of these economies bodes well. And we're anticipating about 13% annual growth in exports over the next few years. And a big part of that export growth is going to come from the fact that experts are now pointing to a new super cycle, a new commodity super cycle that has begun this year, 2021, and many believe will last for 4 to 7 years. Why is that? Well, on the one hand, you have this cheap capital, which means there's a lot of spending on infrastructure as governments try to create jobs as a way to get out of their economic recession. We also have, again, with cheap capital, private enterprise investing in large capital projects, which tend to consume a lot of commodities. You have the fact that much of the emerging markets, so the big population countries like China and India, Turkey, Pakistan, Brazil, Mexico, are reigniting their economies. People are driving again. Traffic jams in Latin America are back to where they were. People are flying again. And this has a big upward demand on energy and energy consumption. You put that all together, plus the fact that there was very little new exploration and expanded extraction. In fact, extraction dropped during the pandemic. You put all that together and you see this upward tick in pricing that we're all experiencing at the gas pump, our heating bills, what have you. And it will continue. That inflation of prices will continue. The last time Latin America enjoyed this combination of cheap interest rates and high commodity prices was between 2003 and 2013, which was the best decade of growth that Latin America experienced in the last half century. So the externalities of the region bode well. Now we'll look at the trends going on inside Latin America, some of which contrast with that optimism. First and foremost, and more controversially, I want to touch upon the state of the pandemic in Latin America. And a very interesting study that was published August 24th in Israel, which of course was one of the first reasonably populated sized countries to reach herd immunity levels of vaccination. And a study was done that compared a cluster of people who had not been vaccinated but had been infected versus another group that was never infected but had been double vaccinated with Pfizer, considered the best vaccination. And what they found was the people who were infected but hadn't been vaccinated were 6 to 7 times better prepared in terms of their antibody count to defend against Delta variant. Now, nobody's arguing against the virtues of vaccinations. We know that they bring down hospitalization rates. They make the infection far less dangerous. But what is proving to be the case here is that vaccination without infection is not a bulletproof solution. And if you look at data, mortality data in Latin America over the last 4.5 months, you will see an incredible plummeting in several markets of that mortality rate, which means also a plummeting of infection levels. And it's not necessarily correlated with the vaccination level, but it is correlated with the previous infection level. Now, why is this good news for Latin America? Latin America suffered more than any region in the world, both health terms, infection levels, death levels, and economic setbacks than any other region in the world. And having gone through that living hell for 18 months and those high mortality rates, they are most likely, therefore, to put COVID behind them. And that will, as people continue to hear week after week about lowering infection levels, of hospitals doing better, et cetera, that will give them the confidence to go back to consuming, go back to walking into stores, go back to engaging in their normal economic behavior. So this bodes well, we believe, for the region over the next 12 to 24 months. At this point, I'd like to ask Guillaume, who runs Global Health Intelligence, a affiliate company of ours, and who runs the largest database of hospitals in Latin America, to tell us what is the state of hospitals today in Latin America in light of this drop of infection in terms of their capacity levels.
Great. Thank you, John. And thank you, everyone, for being here. John, indeed, cases across the region are dropping. And a case in point is specifically Brazil and Mexico, where we're seeing half the number of daily cases than we were 3 months ago. Now, within that, hospitals are working very hard to get patients back into their facilities and back into their operating rooms. In fact, we're currently seeing that procedure volumes are increasing at a rate of 2 to 3% every week. And we've been seeing this for the past month and a half. So a welcome turn of events and a welcome change, certainly across the region. And at this rate, hospitals expect to be able to get back to pre-pandemic procedure volumes by the end of the first quarter 2022.
That's great news. Thank you, Guillaume. And I know you're going to enlighten us furthermore on the industry a little further into our webinar. Let's move on to the next slide and talk a little bit about what has been the cost for governments in Latin America at fighting COVID. The biggest cost has actually been the failure or the inability to collect taxes during lockdown when the service sectors across Latin America came to a grinding halt. That put a big hole in government coffers. And then, of course, in some countries, most specifically Chile, Peru, and Brazil, they did very admirable jobs at extending payments directly to the poor and to small business that cost their governments a great deal. Now governments across Latin America, who were given a free pass, I would say, in 2020 in terms of running big deficits, as were countries around the world. Now international lenders and the ratings agencies are really coming down hard and obliging them to either raise taxes or lower costs. And that's where politics plays a big role in making those decisions, as we'll see in a moment. Let's move forward. One of the biggest questions people pose to us is, what is the future of the currencies in these markets? A lot of our clients are multinationals who repatriate profits from these countries and need to understand how these currencies are going to perform. What's really interesting is that this time around, in the past, during economic crises, and this is the sixth that AMI has lived through, that our consultants have lived through over the last 29 years. But what's interesting, in the past, there would be so much capital flight out of the region that central banks would have to intervene and raise interest rates at the worst possible moment to try to stem the flight of capital. This time around, there was much more amazing reforms have been taking place in Latin America across several countries to help build national savings and keep that money in place. And so central banks this time around were able to actually keep interest rates the same or even lower them as their immediate response to COVID and to lockdowns. Brazil, however, was a different story. Brazil had moved towards tightening its fiscal budget and had loosened its monetary policy before COVID. And that was proving to be a very effective policy shift to ignite investment inside Brazil by Brazilian savers. But their response to COVID was so dramatic that they suddenly went to a combination of a loose fiscal policy combined with a loose monetary policy. And that's why you've seen their currency take as big a hit as it has, and why it's going to take Brazil longer to strengthen their currency over time. Okay, let's move forward. When we put together a number of different factors, and you see them listed here, and there's a bunch of numbers on this table, but I point your attention to the arrow down below. And on the left, we have the countries that we feel are rebounding most robustly and quickly. And on the right, those that do not bode so well for a quick recovery. And we've ranked them based upon these metrics. So again, this may or may not be relevant for your industry, but if you are looking across the whole region, we're hoping that this analysis is helpful to you guys. As you can see, the rebound, even though all these countries fell, the rebound is very uneven and there's big differences. And on the next slide, we'll see where there's even more dramatic differences. We are all now very well versed in the pandemic's impacts on different industries. And there were certain industries that benefited from the pandemic, e-commerce being one, medical supplies being another, software apps and technology, fintech being some of those. And there was several traditional industries that really suffered. What's interesting is now we're seeing a transition towards a post-pandemic economic reality. And just to point out three of Latin America's most important industries, oil and gas is now the highest growth sector in Latin America. Automotive has increased as well, as demand for cars and for new cars has increased. But there are other industries that stand less of a chance of a robust recovery, one of them being brick and mortar retail. Of course, as e-commerce has reached higher penetration levels around the world, certain niches of brick and mortar retail have suffered, and the same story is going to take place in Latin America as well. I'd like to turn briefly to Lindsay Lehr, who runs our payments practice. And for several of our payments clients, travel is an incredibly important client sector for them. So Lindsay, you've done a lot of analysis of the travel sector. What's your prognosis for the industry?
Thanks, John. Yes, it's a great question. We get this question a lot from our clients. AMI, when we look at the travel industry, we project multiple industries and their rebound over the next coming years. We see travel not fully recovering until the end of 2024 or even into 2025. But just like anything, you have to break this industry down into its multiple segments, right? When you look at the US, domestic travel, according to various sources, has already rebounded to 2019 levels or even exceeded it in some cases. Latin America, which is a little bit more behind in vaccine penetration, domestic travel has certainly accelerated and is on its way to rebounding, but is behind and probably will reach 2019 levels sometime next year. Cross-border travel and, more importantly, corporate travel are still lagging far behind. And what's really going to drag the whole industry down is corporate travel. Corporations have learned that before, when you needed to have an in-person meeting, that has been now solved with technology. And there's the question, will corporate travel ever fully recover? And now that we're used to doing things online, of course, there's liability and issues related to companies sending employees overseas or on a plane. So we expect, domestic is already recovering. We see a lot of activity. People are anxious to travel. People are ready to travel. Certain segments, if you've been vaccinated, are ready to return to their old activities. But the industry as a whole is still lagging behind pre-pandemic levels.
Great. Thanks, Lindsay. I want to now talk about, on the next slide, where we are in terms of this is the cold showers. Up until now, we've had a fairly positive sounding outlook on the region, but there is an important fact that unless you're living in the region, unless you're walking the streets in the region, you probably are not fully aware of. And that's the fact that Latin America, already the most economically divided region in the world, just got a lot worse. Latin America has done an admirable job at fighting poverty and reducing poverty pretty steadily over the last 30 years. Half of that progress, 15 years of progress, was wiped out in 7 months of lockdowns. And the Gini coefficient, which is sort of the universally accepted measure of difference of income levels, the higher the number, the worse is the income distribution. Took a big leap last year and continues to grow. In fact, 500 million Latin Americans are still worse off economically than they were before the pandemic. And I think that what makes this situation even more conflictive is the fact that many of those people, the vast majority, represent the bottom 60 to 70% of Latin Americans economically, who work informally. About 60% of Latin Americans work informally. And those people, in the time of quarantines, had no way of pivoting online. There was no way for them to work via Zoom calls. They work in restaurants. They work in street markets. They are part of that cash-driven economy in Latin America that employs so many people. Meanwhile, they were being dictated rules by government officials who were able to keep their salaries and work from home comfortably. And that led to a perception by those 70% that the government's policies were insensitive. And it's little wonder that we've had over 60 waves of protests across Latin American countries since the pandemic began, the most dramatic being, of course, in Colombia earlier this year. And this is having repercussions politically. It is wrong to perceive this as a shift to the left. This is not about a shift to the left. This is about a rejection of the status quo. in every election that we've seen during the pandemic, the sitting government has, or the sitting parties have lost the faith of voters. So for some countries like Peru and Chile, that's been a move to the left. For others like Ecuador, it's been a move to the right. In Argentina, where they had by-elections, they also rejected the Peronists. So we expect this anti-incumbency to continue and to probably elect more and more populist type leaders, whether they're left or right. We'll soon see. But that is, of course, a somewhat frightening notion for investors, because populists generally are less respectful of the rule of law and more likely to try to change the rules. And of course, change and uncertainty is the worst thing that you can deliver to business in terms of making their investment plans, particularly in capital-intensive industries that require long turnarounds on investment. So I think this is something that we have to be mindful of as we talk about the positive externalities. If we talk about some of the positive trends we're going to be turning to in the latter half of our webinar here, is keep this in mind. The state of 3/4 of Latin American consumers still being pretty rough going. Okay, let's move forward.
All right, well, thank you so much, John. This brings us to our second poll. We'd like to get a sense of how you view risk in the coming year. So in this particular question, we're outlining a number of different risks, and we'd like you to tell us the top three. So if you look there and just sort of pick your top three of all the risks that are on there, we'd like to be able to get a sense of that and see sort of where you guys see the challenges coming. As you can see, there are a lot of different options, and it's good for us to understand sort of where you see your risk as well, because a lot of the work that we do does involve risk planning and management, particularly in mining, but of course in other areas as well. All right, I'm going to give that just a few more seconds to log your responses and make sure that we get as many as we can, and then we'll share the results. All right, let's take a look at those results there and try to see if we can identify some of the top ones. So based on this, let's take a look here. One of the biggest risks looks to be the local LatAm elections, the sort of the political landscape, which is certainly possible. Then the currency depreciations at 38%. So LatAm elections were at 42. The currency depreciations at 38%. So that was one of the other ones. And then the other top risk that you guys identified overall was weak or falling demand at 29%. All right, so that's very helpful for us. Thank you so much for that. And now we're going to move on to the next part of our presentation and get into some of these larger trends. One of them is the explosion in demand for digital commerce. And for that, I'd like to turn the floor over to Lindsay Lehr, who heads our payments practice, to discuss trends in that area. Lindsay.
Thanks, Abel. Hi, everyone. Great to be here. And I'm so pleased to be talking about this subject. John gave us a really good overview of some of the driving forces of e-commerce and digital commerce in Latin America. And what I'm going to do today is talk about 5 predictions for e-commerce in particular through 2024. We saw e-commerce as one of the best performing industries as a result of the pandemic. That has proven to be true throughout 2021. And actually, we forecast rapid growth through the next couple of years, growing at 31% annually, exceeding $600 billion by 2024. So stealing share away from brick and mortar retail, and bringing new consumers into e-commerce for the first time. And, John's analysis of the growing levels of inequality in Latin America is actually one of the biggest drivers of the payments industry, as models which have been previously expensive, monopolized, exclusive, are now becoming more horizontal, more accessible, more transparent, lower prices. A lot of times, the reason people go to shop online is because they find cheaper prices online, and with better access to e-commerce and payment methods, now greater swaths of the population are able to access digital commerce. So really interesting stuff here. A couple of trends to point out. We're seeing a shift in retail e-commerce towards marketplaces. And this is not talked about all that much, but it's a very salient trend in which local domestic department stores are investing heavily in marketplace infrastructure, basically leveraging all of the digital technology and infrastructure they've built, leveraging that to include third-party sellers on their site. So they don't have to be responsible for inventory, but they basically rent out their space to third-party sellers. We expect marketplace to represent almost 50% of retail sales in 2024 when we look at e-commerce. Similarly, another 25% of retail sales are going to be occupied by sales via social media and a new phenomenon, which we're calling live commerce, in which buyers are interacting directly with influencers on social media. This is a new and emerging trend, very already starting to become ingrained in Brazil and spreading throughout the region as platforms like TikTok become more popular. On the payment method side, as we said, payment methods becoming more accessible, more democratic is a term that we hear a lot in the industry. Bank transfers, very much spearheaded by Pix in Brazil, central bank's instant payment platform, today representing a very low share of e-commerce. Thanks to Pix, will represent almost 10%, will gain, more than 5 or 6 percentage points in the next couple of years, growing, doubling every year in Brazil in particular. So this is making e-commerce payments faster and more available to anyone who has a bank account or a fintech account. So making payments even more accessible. And then e-commerce financing is also growing thanks to, installments have always been relevant in Latin American retail. And now, thanks to the arrival and growth over the next couple of years of buy now, pay later and other types of innovative credit, over 50% of sales will be financed. And this is, of course, important in an environment in which income inequality is growing and people's purchasing power has been decreased. We know that Latin America goes heavily towards financing at the point of sale when this is the case. So we're seeing more innovative solutions become available. All of these trends together are driving a migration of sales from the physical channel to the digital channel. And so this is why we're seeing sustained acceleration even after this initial disruption because of the pandemic. And on the next slide, I just want to briefly mention a wider trend taking place across payments in general, which is what we're calling a transition to the platform economy, in which payment services across every area of the industry are migrating toward platform infrastructure or X as a service. For example, banking as a service, in which fintechs are enabling anyone to offer banking services. We're even starting to see crypto services, crypto as a service, to offer banks and others the ability for consumers to access cryptocurrencies through their platform. Commerce platforms that are enabling people to sell over social media, SMBs to launch their online store faster than ever. And financial super apps. We've been talking for years now about super apps in general, and more recently, this idea of financial super apps, where banks and fintechs are enabling services far beyond just banking within their app. We have Revolut arriving in the region. We have traditional banks like Itaú and others launching their own marketplaces, moving into commerce. And so the lines continue to blur. And companies are no longer operating in silos, but moving towards a platform situation where you have your technology that you've developed, and then you make that available to third-party sellers, increases access, increases revenue for yourself, makes you a more competitive player overall. So very exciting things to come in the short term. All right. So with that, we'll continue this discussion around e-commerce, looking at the logistics industry. So I'll turn it back over to John.
Thanks, Lindsay. I'm pleased to comment on the logistics industry, which is run by Diego Rodriguez. He runs that practice for us. He is enjoying his honeymoon in Europe right now, so I'm stepping in to present his slide here. As people in the industry know, the pandemic has generally been positive for the logistics industry, specifically for local fulfillment within of domestic e-commerce. What did not grow nearly as dramatically was cross-border e-commerce, except in a few areas such as health supplies and things like that. What we're now seeing is tremendous rebound of and stronger growth around cross-border e-commerce is driven by a couple of things. In bigger markets like Mexico and Brazil, where you can source almost everything locally, what you have is a millennial consumer base and an affluent consumer base who are buying international brands. They're aware of these brands. They're aware of international websites. The affluent often can only source internationally the products that they seek. And so that's what's really driving that part. In the other areas, ocean and air cargo, we're seeing upward pressure on prices. There will be some alleviation of pricing in the ocean cargo area, but generally speaking, both of these industries are doing extremely well as there's a rebound in demand as consumers who've been holding on to that cash, holding on to that savings, wondering how long the pandemic's going to last, now feel more comfortable spending. And we're seeing how that's materializing in the trade of goods. And then, of course, ground cargo. What's really interesting is in the US, truckers are overextended and in shorter supply. And so now Mexican truckers who by law of NAFTA are able to make deliveries into the US, but generally only took it to the border, and US truckers who pick it up there are now delivering to the US to help make up for the shortage of truckers in the States. And that's now creating a shortage of truckers in Mexico. It's a great example of how the US economy pulls Mexico. Down below, you'll see that generally speaking, we're talking about upward trends on rates. The logistics industry looks to have an excellent year next year. Now, I'd like us to just ask you again. I think we're going to go to some questions, right, Abel?
Correct. We have a couple of questions here for you guys in this particular area. So first, I want to address the first one to Lindsay. Lindsay, you mentioned cryptocurrency very briefly, but could you take a moment to talk about what you expect in terms of the adoption of cryptocurrency in Latin America next year?
Yes, Abel, thank you. It's really been astounding. The level of interest in crypto and the amount that it's spread like wildfire across the region. Almost every day we hear about a new crypto product launch by a traditional bank or a fintech player, a new exchange offering something innovative. So we're starting to see this really penetrate the lives of regular people, whereas prior to 18 months ago, it was very much a niche type of thing. Now there's wide interest of crypto across all economic, social economic status levels, and people of all walks of life. We actually, to get a better handle on this, we recently launched a survey among 400 consumers in Latin America to understand levels of adoption of cryptocurrency. And we were very surprised to see that 8% of consumers report to already have purchased a cryptocurrency of some kind. And that is really remarkable when you consider that credit card penetration, a product that's been around, very well known, been around for 50 years, is at between 10 and 20% penetration in these same markets. So rapid uptake, rapid interest. In addition to that 8%, we see about 18% of folks who are interested in buying cryptocurrency, but they don't yet know enough. They don't yet feel comfortable. And so in the next year, we can envision many of that 18% purchasing. So if in the next year, all the crypto curious folks were added to that group, we have almost 30% of Latin Americans dabbling in cryptocurrency. What is still unknown is exactly the use cases that people are going to be using it for, who the players they trust are, how they're going to be using cryptocurrency. But we do know that consumers are very interested in products that bridge crypto with traditional payments infrastructure like debit cards and payment via QR code. So we're going to be exploring this a lot more in the next year to gain further clarity, but very exciting to be observing.
All right. Thank you so much, Lindsay. The next question I have is just quickly for John to discuss logistics there. What type of logistic companies are fulfilling the tremendous increase in demand that has come from the lockdown that triggered that spike in e-commerce in Latin America?
Thanks, Abel. Before the pandemic, the most important segment of e-commerce was, from a logistics standpoint, in terms of the amount of money that's spent, was cross-border. And it was dominated by the global players who operate around the world, the big names. The pandemic really drove domestic e-commerce of essential goods And a lot of the new customers in domestic e-commerce are very price sensitive. And so they require very low cost logistics solutions. And in fact, the big global logistics companies are not well positioned to handle that very low cost domestic e-commerce fulfillment. So a lot of new players, very nimble, sort of Uber-like models have sprung up across these markets to provide local logistics. As we move past the pandemic and e-commerce demand rebalances between cross-border and domestic, we will see the bigger international global brands capturing a lot of that growth again. At this point, I think, Abel, we wanted to poll our audience again. And on the next slide, I believe we're going to ask you the next poll. So you've just listened to Lindsay and myself analyze a particular industry or a couple of industries around a particular trend. And many of you have already worked with us in the past, but what we want to offer is a 30-minute free consultation where you share with us some of your plans or concerns about the region, and we give you our feedback, we give you our input. If you think this is something that would be valuable to you, please go ahead and answer yes. If that's not something you need at the moment, go ahead and answer no. Or if it's something that you think you might look forward to towards the beginning of the first quarter of next year, we're happy to have such a call with you then. So we're not going to publish the results here. We do capture this information by each respondent. And if you answer yes, we'll take it upon ourselves to get in touch with you. We're going to end the poll in just 5 more seconds, and then we'll move on from there. Okay. Now let's talk about our second trend. I'm just sending a note here. We want to talk about the second trend, which is really about the commodity supercycle. And I think I went to fairly lengthy discussion of what's behind the supercycle, so I won't repeat that. What I'm going to do is I'm going to invite my colleague Alejandro Álvarez to talk about how the mining industry is reacting to this incredible demand, and what are some of the challenges that the industry sees across Latin America, in spite of the fact that pricing looks so positive.
Thank you, John. On this slide, you will find how we at AMI assess risk in the mining sector. We divide risk into 7 categories, all interconnected, and we've colored them red for worsening, green for improving, and yellow for static. And as has been mentioned by my colleagues before, the fiscal crisis resulting from the COVID pandemic has left the region short of money. And mining has been one of the bright spots in Latin America. Therefore, there is tremendous pressure on politicians to tax mining. Out of political interference comes pressure to change the legal and regulatory environment. There are growing debates about the sovereignty of subsoil assets in the region. Do they belong to the concession? Do they belong to the country? This is something under debate right now in Chile, for example, as that country considers writing a new constitution. And water rights are one of the top issues that are going to affect miners there, particularly in the more arid jurisdictions in northern Chile. Separately, over the years, we've detected that emerging mining jurisdictions where there could have been mining many years ago, but there's not been a lot of industrial mining in recent years, the political class in those countries is unaccustomed to writing rules for mining. A classic example of this is Colombia, where we see urban voters influence the political class to make it more wary of the mining sector. And if politicians are unaware of the economics of mining, therefore they are not able to properly tax it. Regarding community opposition, which in spite of all that's been said about the threat of resuming the resource nationalism we saw some decades ago, community opposition remains the #1 threat to projects in Latin America. Too little attention has been paid to communities by host countries or miners themselves. And communities have a lot more tools now at their disposal to exercise their dissatisfaction with governments who failed over the years to transfer wealth coming from mining projects. There is the additional cost of dealing with safety protocols and lockdowns during COVID, which has increased costs for mining operations, obviously. Miners did generally a good job at providing safe environments for workers and communities, but this obviously brought in additional costs, and now fuel is more expensive, and there are expectations of higher wages based on higher metal prices. So there are significant pressures on the operational side of mining as well, not to mention other pressures that have been building around mining over the last years, ESG, community issues. We see tremendous pressure overall building against the mining sector, especially in Chile and Peru, which are two of the most important mining districts in the region. In Peru, for example, we see that President Castillo had a strong anti-mining platform, but now once in office, he realizes how much economic dependence his government has on mining and has backed off tremendously from the promises of higher taxation, more regulation, and shutting down certain mines. So we see a different kind of backlash going on politically from what we are accustomed, and that's where we are today in the mining risk environment. I want to emphasize how this changes from country to country, and that the largest risks to mining are local, not even at the national level or the subnational level, but project level. But I hope these broad comments about the industry as a whole will nonetheless be of value. And with that said, I would like to introduce my colleague, Arthur Deakin, for his take on the energy industry in the region.
Thank you very much, Alejandro. Pleasure to be here as always. So by now, many of you have probably heard about the energy crisis that several regions in the world are going through. It's led to around a tripling of gas prices in Europe, mostly because of a shortfall in wind generation, low rain amounts in Latin America, which has led to small amounts of hydropower, and then also bottlenecks for supply of inventory of gas. So those things combined, in addition to some other geopolitical issues, have led to this spike in energy prices overall. What does this mean? Well, many have used this energy crisis to call for a stepping on the brakes in terms of renewable energy investments. They're arguing that there's not enough exploration of fossil fuel assets, that this transition is happening too fast, and it's leaving countries and energy supplies lower than the demands that the world currently needs. What we see right now is actually a commitment by governments to spend $99 trillion by 2050 on energy transition investments. What we actually need is 131 trillion. So that 33 trillion gap is actually going to be filled out by capital markets, by private lending, and it's equivalent to around 4.4 trillion per year. This seems like a very, very large amount, and it is, to be fair. But if you compare it to other instances in history, we can see that it's actually been done before. You look at the Industrial Revolution in the 18th century, Great Britain actually spent 12% of GDP in those processes, in those technologies. What we're looking at here at 4.4 trillion per year is actually equivalent to 5% of GDP. So it's less than what we saw in the 18th century. We have much more knowledge than we did back then. And we have several different methods of financing this transition that were not available back in the 18th century. If we look at the next slide, I wanted to narrow down the amount of spending that we need in Latin America. So it's actually 1 trillion for emerging economies per year is what's necessary through 2050. For Latin America, what we need is around 132% increase from 2026 to 2030 compared to what was spent in 2016 through 2020. That increase is a large amount, there's no doubt, but when you compare it to other emerging economies like Southeast Asia, the Middle East, and North Africa, the amount needed in Latin America is actually much lower relatively to its peers. And the reason behind that is because Latin America has liberalized its energy markets, it's deregulated its framework, and that has attracted a lot of foreign capital, especially in power generation via renewables. So the amount needed in terms of power generation for solar and wind, etc., is much lower in Latin America when compared to other emerging markets. That doesn't mean that there's not enough, that there's not other challenges that Latin America still has to face. There's a lack of public financing. John mentioned that lots of the governments have strained public budgets, so they're going to have to resort on private capital much more, and we expect to see that grow. There's also political and regulatory volatility. In Mexico, for example, AMLO is trying to throw out the 2013 energy reform. In Peru, Alejandro briefly mentioned that Castillo has tried to be stricter on commodities. They've tried to nationalize the Camisea consortium, or at least there's been talks about it. There's also big fossil fuel dependence in terms of revenues for many of these countries. So there's going to be resistance from transitioning to green energy. There's also, of course, greenwashing, where companies make ambitious environmental claims, but in reality, they're not match what they've promised. So in terms of predictions, there's going to be a stricter regulatory crackdown on complying with these targets set by companies. There's the growth of private sector funds in funding this transition. There's also going to be a growth in public-private partnerships as governments seek for capital in the private sector. And then lastly, there's going to be strategic acquisitions by oil and gas companies as they seek to diversify their assets. So there's a lot happening here, but the main message is that it's doable. It's just an effort that's going to take everyone involved.
Thanks so much, Arthur. It's interesting. This transition is top of mind around the world. I'm actually at a mining conference right now in Colombia, and of course, the coal industry is a big part of that sector. And on the one hand, they're trying to look as green as possible and talk about transition, but they're also enjoying this bonanza of higher prices and surging demand. And of course, the geopolitical spat between China and Australia has helped Colombian exports of coal that much more. Alejandro, what Arthur talked about, this sort of transition and this revolution around electricity transmission and the grid, that is, of course, creating record demand for certain metals in Latin America, some of which, like lithium, copper, and zinc, are produced in big numbers in Latin America. Given the market dynamics that we're seeing and the political dynamics we're seeing, do you see the door opening for a return to resource nationalism around the mining sector in Latin America?
So this energy revolution is creating enormous demand, like you said, John, for copper, zinc, silver, and lithium. Copper, zinc, and silver are metals that are mined in big numbers in Latin America. They are also mined by several other countries around the world. Lithium is a relatively new metal being mined, and Latin America has over 60% of the world's known reserves of lithium. So there is a continued talk of governments taking and restricting foreign investment in lithium. Mexico, for example, is working towards a regulation that would essentially stop new international investments in lithium projects and would reserve that exclusively for the Mexican government to exploit, much like what they've done with Pemex in oil and gas, dating back to the 1930s. There are pressures and there's talk of similar measures being taken in Bolivia and in Chile, and less so in Argentina. But this is something to keep an eye on. And certainly investors in the lithium space are concerned about what they're hearing. But also balancing this, there's the reality that none of these countries has the fiscal resources nor the know-how to build a lithium mining industry within the state infrastructure. So right now it's rhetoric, but it's rhetoric that's scaring away investors.
Great point. Thank you. Thank you, Alejandro. Arthur, you've pointed to and talked about how much investment is required to build, to successfully transition to a greener energy industry. Which countries are capturing the most renewable energy investment?
Yeah, thanks, John. So in terms of renewable energy investment, almost every country in South America and part of Latin America as a whole has high potential. There is high solar radiation in Mexico, Chile, Brazil, parts of Peru, even Colombia. So what it's gonna come down to really is looking at places that have attractive regulatory frameworks and then relatively stable political environments. So I want to point out two opportunities in the renewable space that I think not as many people are looking at. And that's distributed generation in Brazil via solar panels. We see IRRs there around 15 to 20%. It's expected to grow around 6 times by 2030. It's heavily incentivized, heavily subsidized. And as long as those policies stay in place, which they look like they will, distributed generation is going to keep growing. And then Chile, of course, we all know about the very high potential in the Atacama Desert in terms of solar. But what that means is that prices to generate power via solar are very low. And that means that they can produce green hydrogen via electrolysis. And that's something that not many people are looking at. There's a couple of pilots going on. But I truly believe that Chile is far ahead of its peers when it comes to green hydrogen strategy and potential. And they seek to become a major exporter of green hydrogen by 2030.
That's great. It's great to know that Latin America is well positioned. Just adding to that, one of the speakers today at the conference was Gustavo Petro, who's polling ahead of all other candidates in Colombia. And he pointed out that Colombia has some of the best wind geography in the world, more than enough to generate more than double the national gigabyte consumption of electricity. So certainly Latin America has the natural setting for great renewable investment. The question is whether they can capture that investment. At this point, we'd like to address the third major trend that we identified, and that is the rebooting of Latin America's healthcare system. I'd like to invite back Guillaume Corpart to lead the discussion there. Guillaume?
Terrific. Thank you, John. So getting into it, when we're looking at healthcare infrastructure in Latin America, the first thing that we need to understand is the disparity between the number of institutions on one side and the capacity of these institutions to deliver care on the other. And the reason for that is because Latin America is home to about 20% of the world's hospitals. However, only about 5% of the world's hospital beds. So this means that the average hospital in Latin America is much smaller than its counterparts in other regions around the world. And this is particularly true of the private institutions within our region. In addition to this, while Latin America is a very vast region, approximately 85% of the hospital capacity is found within 4 countries. So Brazil, Mexico, Colombia, and Argentina. And as counterintuitive as this is going to sound, the COVID pandemic has had a really negative impact on Latin America's healthcare systems. In the public sector, the economic contraction left certain government coffers empty and certain public tenders completely abandoned or unattended. Meanwhile, in the private sector, we have learned that hospitals really need to conduct elective and even non-critical surgeries in order to generate the revenues that they need to stay in operation and keep their businesses afloat. And with a drop of 40 to 70% in the procedure volumes across the region, we're seeing for the first time in over 20 years, private institutions reporting negative net income on their balance sheets for 2020. So while the recovery is in sight and procedure volumes are increasing, hospitals will only recover a fraction of the procedure volumes that they lost during COVID. This, combined with the fact that hospitals are generally smaller in size, will continue to limit investments in capital equipment and capital infrastructure over the course of the next 2-3 years. So moving on to the next slide. As hospitals strive to regain a semblance of normalcy, they're looking for new ways to boost procedure volumes and to really keep operating rooms open and patients coming into their institutions. And as mentioned earlier, we're currently seeing procedure volumes grow at a rate of 2 to 3% per week in all major markets. And this is really driven by the private sector. Now, achieving recovery is not just about increasing procedure volumes. it really is about treating patients. And what we've seen here is that the COVID pandemic has added to the burden of care that has already existed in Latin America for decades, by introducing new issues, such as the mental health issue, which has been brought to the forefront of the agenda, and has compounded other issues that have been around for decades, such as the obesity epidemic and the aging population. So over the next 24 months, what we can expect to see from a healthcare perspective is a short-term revitalization of sales in implantable devices and consumables as procedure volumes pick up within the hospital setting. A second trend that we're going to see is continued downward pressure on pricing as hospitals focus on their own financial health and well-being. When it comes to capital equipment and capital infrastructure, we're probably going to see some of those investments being postponed a little bit, shifted out farther beyond the 24-month period, as again, hospitals really seek to reestablish their financial health. And finally, we expect to see a possible consolidation of assets in the private sector. And this is particularly in Mexico, where private institutions tend to be much smaller than their public sector counterparts, or even smaller than the regional average. And the objective of this consolidation is really to drive up scale and to increase leverageability of the healthcare system and healthcare institutions.
Great, thanks, Guillaume. I imagine we're going to get some questions around that consolidation trend, because that's certainly of interest to some investors. I want to save the discussion. I know there's a couple of questions you want to answer. I want to push those into the Q&A at the end and quickly wrap up the sort of main content before we start answering questions from our audience. So I want to just summarize where we are as a region. A lot of the strengths of the region are really external forces acting upon the region, whether it's higher resource prices, low interest rates, strong demand from traditional export partners, but also Latin America's what appears to be reaching herd immunization and a strong decline of infections. Another positive for a lot of companies is this migration online and the what this has done, not just for e-commerce, but also how we conduct business, and the fact that more and more decisions are made in Latin America in business remotely, and that has generally helped business productivity. Weaknesses, the biggest hangover, if you like, from COVID is this terrible worsening of the distribution of income, and what that means not only for the consumption of goods from a commercial standpoint, but also politically, and the kinds of politics that might inspire, and how those politics might shape the investment climate going forward. We have a fiscal crisis, which really limits government's ability to generate that sort of counter-cyclical spending that's needed still in many segments of society. We have both opportunities and threats that are coming out of this that we'll leave it to your businesses to interpret, and we've listed a few here. At this point, I'd like us to launch one last poll question before we then turn to you, the audience, and we invite you to continue to upload your questions. But having seen our forecast here and imagining if you can imagine, if you will, both a macro and political forecast combined with a deep dive on your industry, this is the kind of service that we provide. Abel pointed out at the very beginning about 15 to 20 clients that we've done this for in the past. So we'd like to ask you if you would be interested in this kind of a bespoke forecast for your company that we can present to you and your leadership team, probably most relevantly around your strategic or annual planning process. Let us know your response. And if you respond yes, or if you respond you'd like to be contacted in Q1, we will take it upon ourselves to reach out to you and contact you on this point. So I thank you ahead of time for showing your interest there. And at this point, Abel, I'll give it back to you to moderate some of the questions that are coming in and point to us to respond.
All righty. Thank you very much, John. Let's take a look at some of these questions here that we have from the audience. One of them is actually for Guillaume. He just most recently presented about healthcare. And the question is, what are some of the regional differences that exist, and how do these impact the opportunities for medical equipment and device manufacturers?
Good question. Thank you, Abel. One of the biggest differences that we see across the region has to do specifically with hospital size and infrastructure capacity, because so much of the investments that hospitals make are tied to the number of patients that they're able to see, the throughput that they have, and the experience that they have acquiring certain equipment. So one of the biggest trends that we're seeing right now, or one of the biggest growth sectors in terms of equipment that we're seeing, is in robotic surgery systems, which typically cost over $1 million each. So for institutions to be able to acquire that equipment, they definitely need to have three things within their grasp. One is a high patient throughput, so patients that they're able to see and treat. Two is physicians that are trained on such equipment modalities, and three, that they've been able to acquire similar equipment in the past and really increase that learning curve through the years. So, for instance, it's very difficult for an institution that only has X-ray machines to all of a sudden acquire a robotic surgery system. They need to have gone and grown through those other modalities like MRIs and CT scanners. The size of institutions is a key point in leveraging. And we're seeing, for instance, in Chile, institutions that are much larger than the rest of the region. The average hospital in Latin America has approximately 70 beds. Chilean institutions on average have approximately 135. The stark contrast to that, and the other end of the spectrum, is Mexico's private institutions, which, believe it or not, have on average a mere 17 beds per hospital, so making it much more difficult for these institutions to acquire high-cost capital equipment.
Righty, thank you so much. We have another question coming in here from Rachel. A huge amount of oil was discovered in Guyana. I recently read that a pipeline would be built in the near future. Do you think this will have a major impact on Latin America as a whole? And if yes, how? And I think maybe Arthur would be able to address that question.
Yeah, thank you for the question. Yeah, Guyana has just discovered around 10 billion barrels of recoverable oil, and Suriname, its neighbor, about 5 billion barrels thus far. Probably going to grow at least double in both countries. I think that the oil discovered in Guyana is going to be massive, not only for the region, but also for the entire world. They have light sweet crude, it's low break-even cost, low sulfur. So it's a type of crude that's very highly demanded across the world, especially to meet the IMO requirements for shipping industries. So this is not only going to revolutionize the Guyanese economy, but all those economies around it that require cheap, accessible oil. Guyana is going to be able to provide that in an easy manner.
All right, thank you. We have a question, I think they referred to an earlier portion of the presentation, and it says from an anonymous attendee, it says, which scenario is the score for Chile considering in terms of the elections? So I think they're probably talking about perhaps what could be the outlook for Chile in 2022, considering the elections that are coming up. So perhaps either John or Alejandro could take that one on.
Sure, I'll address that. I think the question resulted from the fact that Chile scored so high in our economic rebound scoring table, and while the politics looks worrisome, again, politics, the impact of politics on economy takes time. There is, if somebody who scares investors is elected, it does cause some immediate capital flight, but it takes a longer period of time for them to actually change the way business is done, change the rules, change the regulations, et cetera. And so regardless of who's elected in November, and regardless of who was elected in the Constitutional Assembly in April, the impact of those people and the changes they make do take time. In the meantime, copper prices are going through the roof, and exports from Chile will jump 61% over the next 2 years. And that's a direct result of higher copper prices, which is about 60%. The other thing is the Constitutional Assembly these people are working hard to rewrite the Constitution. But to get any changes to the Constitution approved, they need 2/3 vote of that assembly. And that includes a lot of moderate people and even some very almost reactionary people on the assembly who don't want any changes. So I think that will moderate the constitutional changes that we see. And I think that those fears are somewhat overblown as a result.
Okay, thank you so much. Now we have another one with regard to e-commerce. I think it'd be a good one for Lindsay. Can you expand on how buy now, pay later will change e-commerce use and even credit adoption in the region, and if consumers will take to it the way they have taken to it in the United States?
Sure, great question. Buy now, pay later is a fascinating phenomenon, the way it's caught like wildfire across Europe and the US. It's still, representing less than 1% in Latin America, with these companies only getting up and running this year. So there's a lot of potential in Latin America for buy now, pay later because of the avid appetite for credit. Now, there's a couple of factors in Latin America that make it unique and different from the US. Buy now, pay later already has large competition from installment plans that are already offered by acquirers and merchants, and consumers are very used to seeing these, buy your plane ticket in 12 installments. You can even buy your groceries in 1 to 3 to 6 installments. And around 50% of e-commerce transactions are already paid for using some kind of installment plan. Now, the caveat there is that these are only available to credit card holders. So there are, more than 100 million people in Latin America who are banked, who are online, but do not have a credit card. And so this is the population that buy now, pay later is well suited for. So they have a large market, certainly a large addressable market. The question is, are they able to roll out their product successfully in terms of branding, in terms of messaging, in terms of getting consumers interested in a new payment method? We know that when the value proposition is attractive enough, people will make a different choice. So if they're able to develop a marketing strategy that appeals to consumers, I do see it being successful. Of course, they also have to convince merchants to buy into this. And it will depend on pricing and the fees that they're charging. As long as they're competitive with installment plans, which there's a lot of room to undercut installment plans, which can, if you're offering a financing plan of 12 payments or more, merchants are often paying 10% for that type of product. So there's a lot of room to improve pricing there. So I see a lot of potential, and we'll have to watch to see how it unfolds.
All right, thank you so much, Lindsay. Now we have another question regarding Ecuador. Do you think Ecuador will benefit from the political instability in neighboring countries under Lasso in terms of investment flows, or will its own recent history hold it back?
I'll take a shot at that, and maybe Alejandro, if you want to chime in as well, because I know you've been doing some work in Ecuador recently. But I think that the financial markets reacted very positively to Lasso's election, and Ecuadorian bonds were some of the best performing in the months after he was elected. Certainly the signals that his government have provided have also further invigorated investor confidence. He's looking to remove red tape, to deregulate certain industries. His own government is very limited fiscally in what they can do. So they really need to attract private capital to make any changes to the economy. I think that Ecuador is interesting both in energy and in mining. And maybe, Alejandro, you can comment on some of the changes they've announced to attract more mining investment.
Oh, Alejandro, just turn your mic on and camera. You're on mute.
Maybe he's away from the camera momentarily. So let me just say that the Lasso government have made some important steps in terms of trying to create regulatory or trying to fill regulatory gaps, most specifically around consulta previa. And if they can pass those laws, make them laws and not just, at this point, they're just presidential decrees, then that will really open up mining investment in Ecuador. And in fact, as miners are a little bit scared right now in Peru and possibly also in Chile, Ecuador, which shares a similar, geology to those countries, will benefit from more miner attention, especially if they can pass those laws that are going to provide greater certainty to the industry.
All right, thank you very much. Going back to e-commerce, we have a question from Claire. She points out that Pinterest recently made a big bet on LatAm and it paid off, and that PayPal is considering buying them. So how much of an impact do you think their push for LatAm had on making them a more desirable acquisition?
Hi, Claire. Thank you for the question. That's an interesting question. I don't know is the short answer. I can imagine, this goes back to what we were saying about the platform economy and companies wanting to acquire platforms to gain access to new audiences. Now, PayPal has been active in Latin America for years, was one of the first digital wallets available in Latin America, but has not made strong moves outside of Brazil and Mexico. But certainly all global players are making investments in the world's fastest growing regions. In Latin America on the digital front, for many years now has been a forerunner in e-commerce growth. So I don't know if Pinterest penetration in Latin America has made an interest in PayPal's decision-making specifically, but it does align with the trend that we're seeing of companies going after new audiences by looking at platforms where consumers are active and investing in regions that are fast growing and wanting to capture up and coming groups of consumers. So it's a very interesting question, and I think it speaks to the looking at where these different, TikTok is a good example, right? TikTok is another company that has really invested in Latin America, really succeeding so far in Brazil and starting to reach into other markets. And what companies, Shopify has a global agreement with TikTok to enable commerce directly in the TikTok app through Shopify's platform. So it's an example of the types of partnerships and acquisitions we'll see in order to gain access to new audiences.
All right, thank you so much, Lindsay. Switching gears now for healthcare, this would be a good question for Guillaume. This anonymous attendee is asking, what's your expectation about pricing increases in the medical market?
That's a pretty big question. Thanks, Abel, and thank you, whoever posted it. When we analyze medical equipment, we really look at three types of equipment here. First of which are the consumables. Secondly are the implants like pacemakers and artificial hips and knees and stuff like that. And then the capital equipment like x-ray machines, robotic surgery systems, tomography scanners, etc. And what's interesting is that the drivers and the trends over the pandemic for these three types of equipment have been completely different. We've seen obviously the demand for consumables and implants drop dramatically as procedure volumes plummeted, but the region as a whole has continued to install and implement capital equipment. And the reason for that is that the planning systems around the equipment is really done 2-3 years ahead of the actual equipment reaching the institution. So we've seen during 2019, 2020, 2021, continued and steady increases in the installation of capital equipment. Now, as it comes to pricing, it's really been all over the place, and the pandemic has done some crazy whirlwind when it comes to pricing. And I know that a lot of companies are struggling with this question. I think there's multiple facets to it. First of which is how is pricing changing in terms of how are institutions paying for the equipment? Because there's the traditional acquisition model. There's also leasing models. There's also the pay-per-use models or pay-per-clicks, depending on what kind of system you have in place, or paper bandwidth, whatever it might be. So that's changing pricing. But also what's changing pricing is the not just the acquisition of equipment, but the technology and the quality that's going into it. So an institution might acquire the same amount of devices, but might be paying less because of the downward pressure on pricing, especially for capital equipment over the next couple of years. What I can say from a general perspective is that consumables and implants pricing will likely remain stable, even possibly increase a bit in the short term. Capital equipment, there's definitely going to be downward pressure in the next 2 years. We definitely expect to see a surge in a growth of additional imports from low-cost Asian countries over the next couple of years as well, and that's going to come into the mix and also move around what we're seeing on the pricing front. So it's definitely a multifaceted answer, and one that requires looking into and assessing multiple drivers.
Yeah, absolutely. And it's interesting how you noted about how that planning cycle, because we were just ourselves, looking at robotic surgery and how this year we had all these different hospitals in Latin America introducing that, but that came from several years ago. It's not really reflective of sort of what their plans are in the short term now. It's just from a while back. Yet, we still had a lot of hospitals, bringing out those systems.
Absolutely.
Well, we have a different question here in a different direction from Randall. He's from the Caribbean Islands block, and he is asking us if there's any opportunity for the smaller islands to benefit from the growth trends affecting LatAm as a whole.
In Latin America, in the Caribbean, there's really a strong division between the DR and Puerto Rico, which opened its doors to tourism, going as far very early, requiring no testing, providing random testing to flyers as they arrived. I arrived in Santo Domingo a week ago and was sort of pulled aside for random testing. The point is that the smaller island nations, particularly the English-speaking nations, continued and still continue to have a legacy of strict regulations, and it's really hurting them. The DR in December of this year has already has bookings that are 20% higher than December 2019, which means they are taking market share from the English-speaking islands. Now, the boom in Latin Americans traditionally, when they go to the Caribbean, they go to two places, Cancun and the DR. They do not generally go to English-speaking Caribbean in any great numbers. So I think that English-speaking Caribbean, their policy model was so strict, they've already lost market share to places like Southern Florida, the DR, and Puerto Rico. And as a result, they're going to continue to lag the rest of Latin America in this recovery period.
Okay, thank you very much. Now we have one here that might be a little bit more relevant for Lindsay. So this one is from Bernardo, and he's asking, regarding the political and legal pressures in the US and Europe towards big tech companies and platforms in general, and stronger regulation for those companies, do you consider that this debate will also have repercussions in LatAm? How will the global tax discussion impact big tech companies in LatAm?
Yes, thank you for the question. It's a great one, and it's very interesting. So I think that a couple ways to answer this. Regulators are certainly concerned about big tech, but I don't think not in the same way as they are in the US. In the US, there's a lot of concern about privacy and censorship, tampering with the media, even voting and elections, and a lot of and same in Europe, and a lot of focus on consumer privacy, data protection. I don't think that's the same discussion happening in Latin America. As we know, Latin Americans are avid social media users. They buy in 100% into Facebook, Instagram, and most importantly, WhatsApp. And just a couple of weeks ago, when Facebook had its outage, I think most business people in Latin America panicked because they didn't have a way to connect with their customers and colleagues. And so there's a mega buy-in to these platforms from consumers. And I don't perceive as great of a concern about privacy over social media. However, regulators are concerned with getting their tax collectors are very interested in getting their share of activity, right? So we've seen already regulators starting to tax not so much social media, but digital players, Netflix, Spotify, that there's the famous Netflix list in Argentina, where regulators are starting to collect taxes from digital service providers, whether or not they operate locally in their country. And there's an ongoing debate about how the best way to do this is. Will this deter digital adoption in a region that is actively going through a digital adoption phase? That's one aspect. The other aspect that tax collectors are looking at is the gig economy, and what's the best way to tax workers who are in the gig economy. And we see in different countries gig economy platforms being required to retain worker wages for taxes, and this has changed multiple times and caused a lot of friction between the platforms and their users, their workers. So definitely an ongoing debate about taxing these platforms. The other debate is not so much around the same kind of privacy issues that are going on in the US, but in Brazil, for example, when Facebook wanted to launch WhatsApp Pay, this was coming out at the same time that the central bank was about to launch Pix. And so the government is governments are wanting to provide space and limit competitive pressures from these companies when they're trying to launch their own domestic platform. We saw that happen in Brazil. Now regulators have permitted WhatsApp to go forward, but they wanted to make sure Pix had a chance to debut first. So hopefully that answers the question. We're going to see this debate continue to unfold as these questions become more relevant.
All righty. Thank you, Lindsay. Well, we have another question that switches gear to the energy area, and it asks us from an anonymous attendee, will Trinidad stand to benefit from any oil and gas storage processing out of Guyana? Because they have the infrastructure already in place. So I think that would be appropriate for Arthur.
Thank you for whoever asked the question. They will. Trinidad has actually already benefited quite nicely from providing heavy lifting services, which Guyana doesn't have the local capacity to handle. This is expected to continue, I would say, for at least 3 to 5 years as Guyana raises the necessary investment to build out those third-party services. But honestly, I don't think Guyana alone will be able to fulfill all the necessary services required from the energy sector, even if it attracts all the investment that it's calling for. It doesn't have a large enough labor force, a technical enough labor force, to fulfill those contracts. They recently released the labor local content law, which has very high thresholds that local companies have to fulfill, even for very technical services like 3D drilling, etc. So I honestly don't think that Guyana alone is going to be able to fulfill it without entering into joint ventures with foreign companies. And one quick thing that I forgot to mention in my previous question is that Guyana has also discovered a lot of gas. Probably around 20% of the resources in the Starbeck block is gas. And we actually think it's probably more than what they've disclosed so far. So they'll use some of that to power a 300 megawatt gas generation plant in Guyana, but there's going to be a massive oversupply that will likely be exported to other countries in the region and the world. So they could also become a major LNG export hub as well.
All right. Thank you very much. So we have another one in a slightly different direction. Earlier, this anonymous attendee points out that earlier in the presentation, we indicated that China and the U.S. are the largest export customers for LatAm. So how would this same export customer country breakdown look for only e-commerce? I think either John or Lindsay could tackle this one, I think.
I'll tackle it from sort of a logistics point of view. And then, first of all, how do we define exports? Is it services or products? And I'll keep my answer to products, and maybe Lindsay can chime in on cross-border services or digital products. On the physical product side, Latin America does not export a lot of B2C e-commerce. In fact, the volumes are something like 8-to-1 inbound versus outbound. And a lot of that outbound e-commerce is often B2B. So it's, Mexican companies that are part of a supply chain or part of an internal supply chain. So their customers in the States are buying from the company, and then the company's making an internal e-commerce purchase from a Mexican division or subcontractor. So I think that Latin America in general still exports a lot of commodities. Where they do export finished goods, it's often part of a multi-segmented supply chain. So that's, Maquila's exporting for certain brands, et cetera, and it's almost an invisible source of trade. So there's not a lot of consumer branded goods exported out of Latin America to begin with that go straight to the consumer. And so that speaks to why I think the e-commerce footprint's there. But there are some really interesting success stories in places like Costa Rica, Colombia, Mexico. And by and large, the biggest market for those is the United States.
Okay. Lindsay, are you going to chime in on that one?
Well, I think, John, you summed it up really nicely. The short of it is that there is very little outbound e-commerce from Latin America, even within the region. We get a lot of questions, is there intra-regional e-commerce within Latin America, considering we have some big regional players? And the answer is no. This could grow as e-commerce matures and these platforms look for new markets, including third-party sellers looking to scale, but so far, very low volumes.
All right, thank you. And so we have our final question now, and this one is going to be on consumer goods. So what is your outlook for fast-moving consumer goods markets in the context of recovery with the challenge of socioeconomic polarization that impacts the middle and low class?
If you like, I'll take a shot at that. It's a great question, and I think it's a really relevant one because we've been talking about strong economic rebound, strong growth levels. Certainly countries like Chile are experiencing, massive GDP growth. But I go back to my comment that 75% of households are still worse off than they were prior to the pandemic and are still trying to recover their savings levels and after that, their spending. And so for consumers, there's still an enormous amount of price sensitivity, which tends to lead consumers to move away from global brands to local brands on the one hand. The other interesting modality shift is that Latin Americans, particularly is sort of the top 30, 40% of Latin Americans were big buyers of food service. In other words, they ate outside of their home a lot. These are people generally with double income households, both heads of households working. And so they eat a lot of meals outside. The pandemic obliged everyone to stay at home. And for a lot of affluent, it meant staying at home without the cook that they had in their house. So suddenly the Latin Americans, the wealthy Latin Americans had to learn how to cook and enjoyed it and experimented. And so there's a shift there that's more difficult to quantify, but certainly in the more affluent segments, you see a lot of move towards organic foods, and really a more conscientious about nutrition because they're preparing their own food for the first time in many, many years, if not their whole lives. So you're seeing a shift in terms of what people buy. And for a big 3/4 of the population, you're seeing greater price sensitivity around those basic fast moving consumer goods.
All right. Well, thank you so much, John. I think we've addressed pretty much all of the questions and we've kind of gone past our allotted time here. So I think we're going to wrap things up for now. We want to thank you all for joining us for this. And we hope that the optimistic numbers that you guys showed in the poll earlier come to pass for you and that you all have a great year in 2022. Thanks so much for joining us. And we also hope that you have a wonderful day.